Why were U.S. equipment sales, especially in microsurgery, weak in Q3?
In the fiscal year 23-24, we did have to make a profit warning in June of 2024. Unfortunately, part of the reason was that the microsurgery business was getting weaker throughout the year, a bit worse than we initially had planned for and expected. A key reason is that we're at the end of a product cycle in the early days of a new one. We're launching, and we have launched in October of 2024, the KINEVO 900S, our new flagship neurosurgical product. And as is sometimes natural with these product cycles that repeat only less frequently than every 5 years or so, there can be some weakness in the outgoing product or in the fading product before basically the new one arrives. I think the demand for KINEVO, both the old and the new, was somewhat restrained initially also because of financing environment factors, particularly the private equity clinics where we do a lot of business with in the US have been suffering from the high interest rate expenses, and partly not only the absolute level of the interest rates, but also the expectation of a turnaround in Fed policy and the lowering of interest rates, which eventually happened towards the end of 2024, created a bit of a waiting period where many of these PE-backed investors were basically holding back investment, waiting for interest rates to turn, expecting better leasing conditions going forward. That's beginning to happen. We've seen both the new products being launched as well as the stabilization in order entry, leading to, I think now at the beginning, as we're recording this, the beginning of fiscal year 24-25, to improve the outlook, a much better chance of returning to growth in the US business during 24-25.
Can you summarize your cost-cutting plans and their impact on margin goals?
Of course. In the years leading up to 21-22, approximately, our R&D ratio went a lot higher, peaking at close to 17% and on individual quarter level, even above 17%. The reason for that strong increase from historical averages, which were more in the 12% to 13% area, was the investment in digitalization and cloud handling of data in artificial intelligence that we significantly ramped up in the pandemic years, starting in 2018-19, essentially taking it a notch higher immediately after COVID. And these investments were necessary to distinguish our equipment and our workflows and are already showing great results. However, the monetization in many cases is coming in form of better customer loyalty, better replacement, market share wins in the installed base. We're not so much in the business of selling expensive software licenses, but rather want to create a sticky system of integrated architecture for customers here. This is the reason why we have accepted a higher R&D ratio. However, during 24, as the markets got more difficult, the macro conditions, particularly the US demand for equipment, as well as the Chinese consumer climate, to single out the two biggest factors, became more adverse. We decided that we had to scale it down a bit on the R&D investment, because some of the investment plans, which were and continue to be quite ambitious, were just basically designed for more bullish market projections. And we need to have a reality check here. We did go through a productivity exercise in the middle of 2024 and decided on what products can we deprioritize to a certain extent, or where are we so far ahead of competitors that we can afford a somewhat slower pace of these products. In a few cases, we've also stopped products where we decided that the prospects were not as good anymore under these new market conditions. And regarding also the development progress that we had seen, we now have a more sophisticated planning and tracking tool for much of our R&D pipeline and for many of our business cases that we installed, which is more responsive to market conditions around us and to changes in pricing levels in the market than previous systems that we were using. So I think this whole exercise made the company more agile and more responsive in difficult times without, however, curtailing R&D as much as to hurt future value generation. It's clear that we still, even at the somewhat reduced level, have the highest R&D ratio in the ophthalmology industry, and that will be the case for the foreseeable future. So I would see a bit more potential to reduce the R&D ratio relative to sales. However, the basis of the margin expansion of the next year should be rather in economies of scale as we grow our recurring business and product mix, not so much in cost cutting. We're still a growth company innovation is key to our success in the markets, and that will always be true for Zeiss.
How do you bridge 2024 guidance to the profitability step-up expected in 2025?
For 2025, we are expecting a recovery in EBITDA and EBITDA margin after somewhat rough fiscal 23 and 24. Some of the building blocks for that are the full year consolidation of the DORC acquisition, the recovery from the inventory destocking in China, which was a very large negative special effect during fiscal 23-24, as well as some of the cost improvements on R&D and on sales and marketing that we're targeting right now, and the return to top line growth that we're targeting for 24-25. The amount of recovery at the beginning of fiscal 24-25, as we're recording this, we don't yet want to quantify. We're guiding for at least stable to slightly positive EBITDA development. However, the reason for that is not that we are doubtful of our new product success. It's rather the difficult macro conditions, particularly in the Chinese market around the consumer climate, where the base demand is harder to estimate than usual in such a volatile period. There's some upside through consumer stimulus, which could be unleashed through the year. But of course, no good model or no crystal ball available to exactly quantify that right now. The direction is clear. We should build a base and then recover. It's less clear how fast it will be. Over the midterm, through the cycle, we should get back to a margin range, which ranges anywhere from 16% EBITDA margin on more cautious macro assumptions up to 20% on more positive macro assumptions. So there's a lot of upside from the current roughly 12.5% of EBITDA margin level that we're currently at.
What is your R&D strategy under the cost reduction plan, and where will savings occur?
Yes, although we have to be a bit on the surface as the details are competitively sensitive, as you can imagine. In R&D, we have some wiggle room to adjust the speed of digital investments. We have put in a lot of upfront investments into cloud infrastructure. There's now some room to scale it a bit back down as the infrastructure has been created and it's now about developing applications in the future. And of course, we would like to see as many as possible to create the best value for our users. On the other hand, for some of these use cases, the monetization, commercialization aspect is still several years out and will take some time to fully develop. So here, I think we need to sync the amount of money invested with potential returns from the business and from the monetization aspect. Another area is to combine offerings, particularly between cataract and retinal, with the new possibilities that the DORC acquisition brings us come to mind. And here we have some plans on how to streamline the development plans and assets going forward. And lastly, in the area of IOL development, we are working on fine-tuning the offering for our premium lenses. And there are different materials, different models and types where we are thinking hard about what's the most promising and most direct commercial payback, best return strategy for us here to balance the very high registration costs on the one hand side and the commercial impact on the other side. And here we've made some choices. We've narrowed down our portfolio slightly, but based on experience that we've gathered through the market launch activities in certain regions, applying that to other regions, these are smart choices which should yield better results and better productivity.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.